Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Stanley Black Decker, Inc., ticker symbol SWK. We're looking at Stanley Black Decker today because the company is a Dividend King. So Dividend Kings are members of the S&P 500 who have consecutively increased their dividend payouts for each of the past 50 years. Stanley Black Decker has consecutively increased their dividend for each of the past 54 years. Right now, they're paying out a well above average 4.2% dividend yield. Being a Dividend King puts them in a select group of businesses with other companies such as Coca-Cola, Procter & Gamble, and Johnson & Johnson. Right now, Stanley Black Decker is trading for $74.82 per share. Over the last year, their stock price is down 59%. So through our analysis of their fundamentals today, we're going to try to find out, what are we missing? What could the market have possibly discovered about this business that led to this terrible performance so far over the last year? Over 5 years, Black & Decker is down 55.5%. That's down with a compounded annual growth rate of 15% annually. Over 10 years, the company is slightly up. They're up at a rate of under 1% annually, with their share price being up about 8% over this time. Going back prior to the global financial crisis, over the last nearly 18 years, Stanley Black Decker has only compounded at a rate of 3% annually. Keep in mind, though, that they, again, have paid dividends through all of these years. Right now, they have a 4.2% dividend yield, and their average dividend yield would be in addition to this compounded annual return, although it's likely that this would still be underperforming the S&P 500 over this period. So Black & Decker is only about $4 above their 52-week low. Again, they're down more than 50% from their 52-week high. About 4.5% of their shares outstanding are currently sold short, and Black & Decker has about an $11 billion market cap. So for additional background about the business, Stanley Black & Decker is a manufacturer of hand and power tools. The company operates 3 business segments: tools and storage, security, and industrial. Tools and storage, the largest segment by revenue, sells hand tools and power tools to professional end users, distributors, retail customers, and industrial customers. Security installs electronic security systems and provides electronic security services, including alarm monitoring and video surveillance. Industrial sells engineered fastening products such as stud welding systems, blind inserts and tools, and engineered plastics and mechanical fasteners. The largest end market for Stanley Black & Decker is the United States of America. The company was formerly known as the Stanley Works and changed its name to Stanley Black Decker, Inc. in March of 2010. Stanley Black Decker was founded in 1843 and is headquartered in New Britain, Connecticut. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Stanley Black Decker based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to evolve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. There are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital, and the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And so these business returns are going to be captured here by return on capital. So by asking for a 14% benchmark or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Stanley Black Decker has seen their average returns on capital decline over this period. They ended fiscal 2022 with about 10.5% returns on capital. However, over their last 12 months, they've only earned about 7% returns on capital. Averaged out over these last 5 fiscal years, Stanley Black Decker is earning just under a 12% return on capital. So while that is solidly above that of the typical business, that's below that 14% benchmark we're ideally looking for. And so this is an X to start things off here on metric number 1 for Stanley Black Decker. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Stanley Black Decker's revenues are up by nearly a third. They've increased by 33%. Their earnings are also up slightly, up by about 17%. So modest revenue and earning growth for the business. However, their free cash flows are down massively. Their free cash flows were actually negative over their last 12 months. This was due to a number of things. One is that they had this huge change in inventories over the past year. They also had a large change in other net operating assets. On top of those, they had higher operational expenses as well. So their free cash flows are down over this period, and this is an X on metric number 2. This is potentially particularly concerning because free cash flows are really the lifeblood of any business, and a business's abilities to produce free cash flows now and until judgment day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. So a business can use its free cash flows to reinvest back in the business, make acquisitions, pay dividends, buy back shares, or pay down debt. Again, potentially concerning that their free cash flows are down, and this is our second X in a row to start things off for Stanley Black & Decker. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Stanley Black & Decker on a per share basis. So we're looking for earnings per share growth over the last 5 years. Again, we learned that their earnings are up slightly by about 17%, so modest earning growth there. However, we still want to take a look at what their shares outstanding have done, whether they've been buying back shares or diluting existing shareholders, as earnings are the numerator in this earnings per share equation, and shares outstanding are the denominator. So over the last 5 years, Stanley Black & Decker has diluted existing shareholders by about 5%. So while this is modest dilution, it's less than the growth that they've had in their earnings, and so their earnings have grown faster than their share count, and so this is our first check of the day coming here on their earnings per share, as they've managed to grow their earnings per share over this time. It's not ideal that we see any shareholder dilution from a business, even though this is slight, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business, and so when a business dilutes existing shareholders by issuing new shares, they're increasing the amount of shares that they have outstanding, and they're decreasing your ownership percentage in the business, which ultimately decreases your percentage of the business's profits that you're entitled to. So as a long-term shareholder in the business, even though the pool of the company's earnings are up over this period, your percentage that you're entitled to of those earnings is down. Either way though, this is earnings per share growth, and through our first 3 metrics, we have 1 check and 2 X's for Stanley Black & Decker. Then next up, for metric number 4, it's going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Because of these huge changes and their higher OPEX, their free cash flows are down over this period. In addition to this 5% shareholder dilution, Stanley Black & Decker actually has negative free cash flows. Stanley Black & Decker has actually consumed about $15 of free cash flow for each share that they've had outstanding over their last 12 months. And so this is an X here on metric number 4. Really, to understand the business in more detail, you would really have to dig in and understand why they had such a huge change in their inventories and what that change in their other net operating assets really meant for the business going forward. Then next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. So Stanley Black & Decker ended their fiscal 2022 with $6.9 billion worth of net debt. Since then, they've increased this somewhat, and right now they have $7.9 billion worth of net debt. At the same time, over the last 5 years, they've only managed to bring in $3.9 billion worth of free cash flow, which is just about half of what their net debt position is. So this is an X on metric number 5, as relative to their free cash flows, it does look like the business is overly levered, and they're using quite a bit of leverage in their business. Also worth being aware of again is that over their last 12 months, they've had negative $2.3 billion of free cash flow. So they've consumed that much free cash flow in their business. If we were to exclude those changes in their inventory and their other net operating assets, then the business has produced about $700 million of free cash flow over their last 12 months. So that may or may not be realistic. You'd have to dig in and learn more about the business to understand if that's the case. But even still, that wouldn't be enough to support this debt load going forward. And so far through our first 5 metrics, we only have 1 check and 4 X's for Stanley Black & Decker. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this would potentially give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in Stanley Black & Decker. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the economic reality of the business that's more similar to as if Stanley Black & Decker were a private company. So right now, Stanley Black & Decker has about a $19.6 billion total enterprise value, and we learned that over the last 5 years, they produced about $3.9 billion worth of free cash flow, meaning that in an average year, Stanley Black & Decker brings in about $780 million of free cash flow, although this has been somewhat lumpy over the last 5 years. So when we divide their $780 million of their average free cash flow by their $19.6 billion total enterprise value, that gives us about a 3.9% average free cash flow to enterprise value yield for the business. So while that is slightly above the yield of the 10-year treasury, that's below that 5% benchmark we're ideally looking for to give us a potential adequate risk premium on the business. Again, also really worth being aware of is that over their last 12 months, their free cash flows have been negative. So in real terms, they have a negative current free cash flow to enterprise value yield for the business. Again, just to give a potential approximation, whether or not this is accurate, you have to determine for yourself. But if we exclude those changes, then they've produced about $700 million worth of free cash flow over their last 12 months. And when we divide their $700 million of their last 12 months of free cash flow by their $19.6 billion total enterprise value, that gives us about a 3.5% current free cash flow to enterprise value yield for the company. So either way you slice it, this is an X here on metric number 6. This doesn't necessarily mean that you're going to toss this business out in its entirety. This is just one of our 6 metrics, and this analysis is not financial advice. It's meant to be taken in holistically. These metrics are simple, but when they're combined together, they can be very powerful. Then as a bonus, here we're looking at Stanley Black & Decker's dividend profile. Again, Stanley Black & Decker is a dividend king, paying out consecutively increasing dividends for each of the past 54 years, which puts their track record as among the best of any business in the S&P 500. Right now, they also have a 4.2% dividend yield, which is almost 3 times better than that of the yield of an S&P 500 ETF. However, people make mistakes all the time by blindly chasing dividend yield or a dividend track record, so it's important to stop and look at the underlying fundamentals of a business to determine whether or not that company is potentially able to support its dividends with its free cash flows or its earnings, depending on the type of business. For Stanley Black & Decker, we want their dividends to be supported by their free cash flows. And in 3 of the past 5 years, this was the case. They brought in plenty of free cash flow from 2018 to 2021. It seemed like they were very comfortably able to support their dividend payouts. However, in both their fiscal 2017 and in their fiscal 2022, that was not the case. The company's free cash flows were well below what their dividend payouts were. And again, they increased their dividends per share over this period. Additionally, and the big elephant in the room, again, over their last 12 months, Stanley Black & Decker has had very negative free cash flows because of these huge changes to their inventory and their changes to their other net operating assets, in addition to their higher operational expenses as well. Plus, given their high leverage to their historical cash flows over this period, it does look like it would be pretty difficult for the company to be able to continue growing these dividends, and it doesn't look like it would be potentially sustainable for the business going forward unless the company was really able to get their free cash flows back in gear and back to where they have been in some of these previous years. That potentially could be the case, but it's just going to require a deeper dive into Stanley Black & Decker to be able to determine that one way or the other. As it doesn't look like it's a no-brainer one way or the other, just looking at their financial fundamentals here. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Stanley Black & Decker, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows over the last 5 years. Then using historical growth assumptions dating back all the way till 1990 for how the business has been able to grow their average free cash flows. So it's up to you to do your own homework here to determine whether or not these growth assumptions are going to be potentially accurate or applicable going forward for Stanley Black & Decker to give us a baseline projected estimate for the business over the next 20 years. So assuming a growth stage over the next 10 years where they grow their average free cash flows at a rate of 5% annually, then assuming a terminal stage for the business for the 10 years out after that, where these average free cash flows only grow at a rate of 4% annually. If we add in the tangible book value of the company and we were seeking a potential 10% rate of return from the business, then it looks like a fair value for Stanley Black & Decker is only around $49 per share. So that's significantly down from what their current $75 stock price is at. Keep in mind that this discount rate would be including their dividend yield as well, so we would not be doubly counting dividends. And so almost half of this would be coming from their dividend payouts alone. There are a number of reasons why this might not be potentially accurate or applicable going forward for the business, so please be mindful that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Stanley Black & Decker only checks the box on 1 out of 6 of our metrics. They're earning above average returns on capital, coming in at just under 12%. However, that's below that benchmark we're ideally looking for at 14%. Their revenues and earnings are up over the last 5 years. However, their free cash flows are significantly down over the last couple of years. And additionally, the company has diluted existing shareholders by about 5%. Stanley Black & Decker has also added on to their debt load in recent years, and both on a current and an average basis of their free cash flows, it does not look like they'd be able to sustain this debt load going forward unless they really see a dramatic increase in their free cash flows over the next couple of years. Then that was a similar situation. Looking at an adjustment for their current free cash flows and looking at their average free cash flows over this time frame, It does not look like comparing their free cash flows to their enterprise value will give us the yield that we're ideally seeking to be able to give us a potential risk premium over the yield of the 10-year treasury. Additionally, the big caveat for the company is that their free cash flows over their last 12 months have been negative. They've consumed about $2.3 billion worth of free cash flow in their business. And so it looks like the company's status as a dividend king is potentially at risk, especially as they've continued to increase their dividends while again not being able to support those fully with their free cash flows. Then finally, performing a discounted cash flow analysis of the business based off these historical growth assumptions dating back all the way till 1990 for how they've grown their average free cash flows. So again, we were using their average free cash flows, which are well above what their current free cash flows are at. And so if you've done the work and you believe these historical growth assumptions and you believe that using their average free cash flows was the right move for the business going forward, then it looks like a potential fair value for the business is in the high 40s. Again, there are caveats to keep in mind with this, but that's down significantly from their current stock price. There are a number of reasons why this might not be potentially accurate or applicable going forward, so it's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Stanley Black & Decker. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct your research into a business as if you're going to own 100% of it, and you can truly understand the essence of that business and understand what's important and what's not important for the company going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Stanley Black & Decker, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Stanley Black & Decker Inc., ticker symbol SWK. Again, we looked at the business because they're a dividend king and they're currently paying out a 4.2% dividend yield, which is well above that of the yield of an S&P 500 ETF. However, there are potential concerns with some of the fundamentals of the business. That's why it's worth your time to dig in and do this analysis of a business. If you learned something and or you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Stanley Black & Decker with me, and have a great day.